Hey, Beyond Stocks community. Good morning. It's another Beyond Stocks episode, and we've got Garland Benton with Direct Equity Source is our guest today. So he's going to talk to us about his projects in the real estate private equity space. So Garland is the Director of Business Development at Direct Equity Source, bringing over 25 years of experience in private equity with a specialization in oil and gas and real estate. Over the course of his career, he's been involved in over $500 million worth of asset acquisitions and has served as both a limited partner and a general partner in multiple asset classes. As an experienced LP, he's got firsthand insight into the opportunities and challenges faced by investors. His focus is on helping others build long-term wealth through passive income, with an emphasis on diversifying portfolios beyond traditional investments. Our kind of guy. So today, he is passionate about educating investors on the value of self-storage and small bay industrial business park investments. So welcome to the show, Garland. I appreciate your time today.
Hey, I appreciate you having me on. It's a pleasure. Looking forward to it.
Yeah. So we were talking before we started shooting that I am an investor in a self-storage fund myself. I've been in that for several years at this point, but I haven't been in the operator's shoes, like on your side of the business. And so I'm really curious to learn more about how you do self-storage, how you run these deals.
Sure, absolutely. I mean, obviously, storage is a great place to be. You obviously believed in it, putting some of your own capital into it in various ways, and that's really kind of what we can talk about is we all think it's a great sector, but there's multiple ways to get involved. And so it's just really finding the right fit. Are you looking for short-term cash flow? Are you looking for new construction that's going to be back end loaded? There's a multitude of ways to go into storage and small bay industrial, and we have a very unique take on it. And our model is a little bit different than other ones that I've seen out there, as you probably noticed.
Got it. Yeah. So I love that. I would love to dive into that. Like, why do you choose to operate in the model that you do? And I want you to pitch me on this, man.
Okay.
I really want to learn more and see if this is the sort of thing that I would want to add capital to this asset class.
Sure, absolutely. So, as you alluded to in your presentation there, I've been in direct equity markets now for this is my 25th year, starting in late '99, early 2000. So I've seen just about every structure on every syndication that you can imagine, from oil and gas to multifamily to RV parks to single family home fix and flip fund that I managed for several years here in the DFW Metroplex. So I've seen the full gamut of every way you can do it. And so, which brings us to where we're at today and our current structure that I think sets us apart. And so basically what I like to do is look at what's out there, what's the best fit for you, and really what gives the investors the best chance of making money. As you probably have seen through the years doing this yourself, all these are usually structured in the way I compare it to Las Vegas. The house always wins, right? Typical structure is, the sponsor has very little skin in the game. Investors like yourself put up all the money, and if it's successful, great, everybody wins. But if things go south, your sponsor's always making a profit, always keeping the doors open, paying their overhead while the investors are just, stuck with a bill holding the bag, right? So we've seen a lot of those deals out there. So we really wanted to structure this deal in a way that puts the investors first, and I think we've accomplished that. So I think what you'll notice in ours right off the bat is our sponsor and my partner, AAA, we're putting up around 20 to 25% of the actual cash in the whole deal. So like this certain tranche of money in this offering, it's about 40 million. We're putting up between 10 to 12 million dollars of that cash as a sponsor. So I mean, I think that stands apart from anybody else in this industry. Not saying that they're not out there, but I've yet to see a sponsor typically put that much stake of their own cash in the deal right alongside of the investors with the exact same terms of the investors. That's another thing to look at. There's not waterfalls of the Class A shares, Class B, and a scaling. They're literally side by side, same treatment, same rate of return as the investors like yourself, if that makes sense.
Got it. And I would agree as a guy who looks at a lot of deals. I get a ton of deals sent to me. I'm constantly being pitched by people, which I enjoy, by the way. But I would say, yeah, 25% of the equity check being funded by the sponsor is really good. Like that's a big number, and I think it's important to share with people why I like that as a potential LP in your deal. Is it shows that you have a lot of skin in the game, and your phrase I like using is you eat your own cooking, right?
Exactly. Yeah, exactly. So I think that's one of the big things that sets us apart. And then secondly, I think everybody, to me, I always look at results, right? I mean, we live in a day and an age, let's be honest. Everybody has beautiful brochures, technology that you've got today. You always see these crazy returns being thrown around and great websites. And, it's just all hopes and dreams, right? And everything's positive, right? But when you really dig down into it, what you find a lot of these syndication companies is maybe they've been around 8 to 10 years. And I always ask if I was going to put my own money in it, I would want to know as an investor, how many times have you actually accomplished this model, right? Like we can all have a business model and a business plan and a 5-year pro forma, right? Those are easily created with the technology we've got today. And the numbers are always going to look great, but you always want to know, how many times have you gone through this entire process? How close to these rate of returns numbers did you actually achieve and provide for your investors? How long have you been doing it in general? And those are all really important things that I think get overlooked when people are doing their due diligence on syndications. Again, no matter what sector, real estate, oil and gas, all the same in my book. These are things that investors, don't ask and don't dig enough into. They just get caught up in the presented numbers, not what have they actually done. So
So
that's
how
one
long have
thing.
you at Direct Equity Source and AAA being your development partner? How long have you been in the game?
Sure. So we have syndicated for AAA and various entities for going back about 7.5, 8 years. We've aligned ourselves. That's kind of what brought us to our model today. When we first started, we were doing property syndications. We would just literally create an LLC on every single property, all the filings, run through a 506C, put one property in it, fund it. And we got to the point that we were knocking out 5, 6 properties a year and just having to go through that routine over and over and over. So as an investor like yourself, historically, you would have to invest 5, 6 times that year with me if you wanted to be on each one of the properties. So here, about a little over 2 years ago, going on 3 years, we changed the model to make it more of a fund format. Whereas if we're going to do, say, 10 properties this year, let's put them all in one partnership, one simple offering. So you as an investor coming in, you get diversified across the board. You put your capital in one time, you're going to be in 10 properties. So I would just believe that that model makes a lot more sense than you having to invest 10 times if we were going to do 10 properties. So we went to the fund format about 3 years ago. Now we're doing larger funds, more numbers of properties. Like I think our current fund, as an example, we have 22 properties that we participated in it so far. By the time it's all said and done, probably have upwards of 30, 35 properties in it maybe, but right now today we're already at 22 properties. So you as an investor come into the fund, you're going to be well diversified geographically, and different type of assets. I know we've talked about just self-storage, but we also have a component we've been very successful with, that is the small bay industrial parks. So this is a nice blended fund. I believe right now we've got 15 climate control storage facilities and we have 7 small bay industrial facilities. So you got a nice blend of each coming into the fund.
Now, I kind of see self-storage as not necessarily a need, but more of a want from the consumer standpoint. Maybe you would disagree with me. Some people have a lot of stuff and maybe they do need self-storage. But one question I have for you is if we were to enter into a fairly deep recession, like how sticky is that consumer? Do people pull their stuff out of self-storage units and or abandon their self-storage units? Like how much of a threat is that to your business model?
No, that's a great question. I think even one of the slides that I had shared with you kind of addresses. Let's look back to what happened in
Yeah,
2008.
let's
It's a
take a look at that.
great example that you brought up, and I think that's what draws the investors towards self storage more than a lot of other real estate asset classes today. I have a lot of people getting out of single family homes, getting out of multifamilies, getting into storage because of what you had just mentioned and the downturn. How do these things perform? And so I think when you look back in the 2008 environment, everything across the board went down. Self storage was actually the least affected of any real estate asset class. That's any across the board. We were actually the least affected with just a few percentage points that they dropped back in '08. So, I always tell people storage to me, it is a want, but it's a need also. People are using storage for completely different reasons. For example, in the downturns, when the economy is not doing well, what you see a lot of is people downsizing. They're not wanting to get rid of their sentimental things, so they put them in storage to try to hold on to those, but they're downsizing overall. What you see now in times of growth and when our economy is booming, human nature is greed. What do? You're accumulating more things, right? Where are they having to put these things? In storage. So for completely opposite reasons, whether it's downsizing during a downturn in the market or everybody's doing very well and accumulating more assets and more things and stuff for completely different markets, we've been able to do very well, even in the good times and the bad. So I always say that about storage, whereas you don't have, having an oil and gas background, it was always peaks and valleys, right? You had
Yeah,
amazing times and you just had terrible times. And so it's a wild ride, peaks and valleys versus storage. You're just not going to have that high and you're not going to have that low. It's just kind of a steady, boring, predictable trend with very little fluctuation to the high or to the low. And again, as my investors age and are looking to be risk adverse, that makes more sense to them than the peaks and valleys of some of these other market swings.
got it. No, I'm gonna switch to show some of these photos that you shared, but these look like really nice quality facilities, like A class self storage facilities. A question I've got is, as I see a lot of research or news around multifamily, or really our economy in general, we hear about this K-shaped economy, right? Where the higher end of the market, taking multifamily, for example, rents are a lot firmer. Like the market in general is just stronger with A class multifamily, but then in lower quality multifamily assets, for example, might be struggling in terms of occupancy, a bad debt, or just performance in general. So my question to you is a similar dynamic happening in self-storage where the A-class facilities are performing stronger and are more resilient due to the consumers that they appeal to, as opposed to like a B or C class self-storage facility?
Yeah, I feel like that's the case, but I'm glad you shared this image because what I want to set us apart here, and maybe we should have talked about it a little bit earlier. So our entire model is not an operational model of what things are going to be 3, 5 years from now. I know there's a lot of models of ways you can invest that are in it for the long term, and that's the risk you take. What is the market and occupancy going to be the next 5, 10 years? Our sponsor, AAA, is what you consider a merchant builder. That means they're building with the intent of selling these properties in a 3 to 5 year period of time, completely built and out of them in that 3 to 5 year period of time. So we're really not tracking markets, what they're going to do over the next 5, 10 years, because we'll be out of the entire property during that period, that first 3 to 5 year term. But this picture you have is what we build. These are full climate control, Class A, drive up, single story facilities. Typically will range anywhere from 60,000 on the low end up to 120,000 of square feet. And the reason that we build this model is because our end consumer or our end buyer is typically companies like a Public Storage or a CubeSmart. I'm sure you've heard of those guys or seen them on every corner. So what we do is we build our model, we fill it up with occupancy, and then we look to divest to one of those type companies. There's several other private equity funds that also acquire our facilities, but that's what those guys are specifically looking for. When you talk about asset classes, they want the new builds, class A, certain square footage, to make sure it is worth their resources to go acquire these properties. So that's really what our entire model is to build, be in and out of the entire thing in 3 to 5 years, which our clients like because they're cashed out, they're made whole, and they're not stuck in these things long term. So yeah, that's what
Now,
we build,
if
just
you
that
have a
class A. We
sale,
won't do any kind of retrofitting. We don't do any value adds. I see a lot of companies out there, they're buying, 20-year-old Kmarts or closed shopping centers and retrofitting them to storage. That's great. Maybe those cash flow over time, you can get into them inexpensively, but your end buyer's not going to be a CubeSmart or a Public Storage. They're not going to buy a 20, 25-year-old facility that's been retrofitted. So we just have a very specific criteria. Um, they've been doing this since 1993. They've done the full cycle now 95 times. They've built and sold facilities to large institutional investors. And so they're just duplicating that model over and over and over.
if you sell an asset or assets within your fund, does that capital get reused into building a new facility, or is it just going to be distributed to the investors?
So great question. So how our fund works is that a facility is sold, the principal gets reinvested and just continues to build new facilities, your bases. The profit that we make on each facility, all of that goes out as a distribution to the investors.
Okay, got it. So then this is a fund that's going to be ongoing for maybe indefinitely?
Yes, there's an indefinite time. It's similar to the structure of an evergreen fund, if you're familiar with those. We took
Yep.
several of the key components out of it. It's not a true evergreen, and that you're not having to do evaluation every year as people come and go. This is literally a fund that if you want to be in it 3 years, that's kind of again what sets us apart is we've got that liquidity built in, that exit strategy for you. Your typical syndications that tie you up 5 to 10 years, we don't have that. If you want out, all we ask is we have a 24-month hold period. If you stay in 24 months, you want in out anytime after that, simply let us know. We'll take you out within 30 to 60 days. So we've
Oh, I
got
see.
that liquidity option here that investors can come and go and stay on the ride as long as they want to go. They're going to get we pay a 12% annual fixed dividend during the entire hold period. So you as an investor, every January, you get 12% annual dividend that's paid out. That is not a preferred return that you're just accumulating to the back end that a lot of these guys talk about. This is an actual 12% dividend paid out every January. On top of that, you get to participate every single facility that is sold. You get to participate in the proceeds, the profit from each one of those. And so we kind of have a waterfall structure that I think is very investor friendly. We as a company participate in zero revenue and profit until you've been made completely whole on your original investment. So once you receive your entire basis and investment back, then we go in on property sales and we split that profit. 65% goes to the investors like yourself. 35% comes to us as the operator and sponsor. And then it never goes beyond that. There's not like a third tier waterfall. It goes 50-50 or keeps getting, progressively more towards us. It's once you've been made whole, all profits are 65-35, but that does not affect or change your 12% annual dividend. You'll continue to get your 12% annual dividend regardless as long as you're in the fund.
What I really like about this deal is the fact that after 24 months, I can liquidate out of that deal. And that is in contrast to the fund that I am invested in, the self-storage and fund, where I've been in this thing for years and I do not have any liquidity rights. Like I'm in this until they take me out.
Right.
Yeah.
Yeah. And I mean, it just goes back to being in the industry, 20 plus years. You really go to some of your bigger investors that have been with me a long time and ask, what is it that you don't like about past syndications, other ones that you've been in? You really take the good and take the bad and really try to create a product that's investor friendly. And that's kind of how we come to these nuances, such as the ongoing stay in it as long as you want, exit out of it as you want to, the dividend along the way. People prefer that as opposed to a preferred return, because a preferred return is just, that's mythical. That's assuming the property ever gets sold and meets its objectives, then you would get that, right? So that was one of my big deals, is don't offer a preferred return, actual make it an annual dividend. So yeah, you just kind of take that and learn through the years of what you like out of each offering. And then we've kind of blended it all together. And I think we got a very unique, product with the diversification of multiple properties, the exiting, how much money our sponsor AAA is putting into the deal, all those little nuances I think really add up at the end of the day to align ourselves with investors. And then there's
So
another little aspect that, go ahead.
what's been the take me through like an experience of, let's say I invested with you 3 years ago. What has that journey looked like in terms of returns for me?
Sure. Yeah, it's up to the now. It's been very, very cut and dry. You get 12%. If you're talking about the fund, it's 12% annual. We have properties right now that, I mean, I don't think they're going to be sold here before the end of the year. Obviously, we've got just a few weeks left, but we're looking at a couple of our properties. We have buyers trying to negotiate on selling those as early as this coming year. So there'll be not only the 12% dividend you'd be getting, but now you're starting to get sales profits here next year on some of our earlier properties.
So over the last 3 years, then I wouldn't have had any sale proceeds yet.
If you were on some of our individual properties, yeah, we actually sold 5 of those here in the fourth quarter this year. Those all maintained a 19% internal rate of return to the investors, so they did very well. But as far as the fund, no, this particular fund just began 2 years ago, so we're
Got it.
just now, remember, we look at that year 3 to 5 to be divesting of most of these properties. We're just now coming into the sales timing on this fund. But yes,
Got it.
if you had done some of our earlier individual syndications, I believe we just sold 2 Texas properties and 3 in Florida just here in the fourth quarter that went out to the investors.
Well, so what do you think are the biggest risks here for me as an LP in your deal?
I think in general, what I see as the risk in storage is oversaturation. I mean, that's the common sense. That's probably, if you were to ask me what's the number one concern people have that when they reach out to you is, oh, I see these on every corner. I'm too late to the party, right? It's well oversaturated. There's no opportunity to make money in it. And I think that is a very, very valid statement. I think it's very specific in that it underlines the importance of getting with an operator that knows what they're doing. And again, that's the value I think AAA brings to the table here of doing this now for this is 32 years in business. They have a very specific model of where they build and doing market saturation reports. They'll typically do a 3 mile, 5 mile, and 10 mile saturation study that will show everything anything that's been filed with the county that's in the works and the building permits. And I think they've been very, very selective of where they build. But to me, that's probably the number one in general with storage. What I see the risk to be is market
Okay.
saturation, and make sure you're getting in with an operator that's not building in a market that you're not going to get over a certain occupancy. And that's why that we've aligned ourselves with AAA, is because they've been very good at that. But that's the number
Graphically,
one risk is oversaturation. Simple answer.
geographically, where are your sites located? Are they in primary market, secondary? Are they suburbs, exurbs, in the urban areas? Can you give me a
A
sense of that?
mix of both, but typically secondary. We focus the major metroplexes of Texas, but you're on the outside, the expanding areas. So we do have some like centrally located in Austin that are being built right now. But then we have a huge focus, if you're familiar with the Georgetown part of North Austin, just kind of getting out on the fringe. And Georgetown to me is probably one of the fastest growing areas of any of our properties. We've got 2 facilities that just opened there. that are, I think our business park there is almost 100% occupancy already. Our storage just opened here last month and is off to a great start. And so just being very selective in those outskirt markets, but there's just so much growth within Texas, but we are sticking to your Austin, Houston, San Antonio major markets, and then just going on the outliers of the building areas, especially San Antonio and Austin being two of the big areas. Huffmeister down in the Houston market, we've got a new facility going in there. Again, tons of residential growth, existing growth. So you kind of see both. It's not just a stagnant market and you're going in the middle of an established city, trying to build new facilities. These are new developing neighborhoods.
Got it.
But as far as geographically, I would say we're probably 70 to 75% Texas focused, but we do have a few facilities in Washington. We've got a handful full of facilities in the Carolinas that have been very good to us in the Charlotte Metroplex and even Florida. As I mentioned earlier, we just sold 3 facilities in Florida. Florida's been really good to us. We've got a new one that's under construction now just outside of Tampa Bay. Um, so in Florida. So you've got a nice geographic mix, but it's definitely a Texas focused fund.
Hmm. Here's what I love about this deal, Garland. Here, the aspects that stand out to me. One, super proven operator, almost 100 of these facilities that your developer partner has built. You've been in this for, I think you said since the 1990s, correct?
93, yes.
So 30 years, 30 plus years of experience doing this. So there's probably not a whole lot of surprises in building these at this point with that level of scale and experience. And I am aware of I have read about like the economic dynamics of customers of self-storage and some of the macro points that you brought up in terms of their resilience as an asset class. I like that about it. The one concern, I guess, that I have is whether that pattern might shift depending on the depth of a recession that we might have. But I mean, past experience does seem to bode well in terms of the resilience of this asset class. So, hey, I like this deal, Garland. I think I would consider investing in your fund.
It's unique. And we'd love to have you. I guess the biggest mind hurdle to overcome is that we're not in operations. I think a lot of people, even after I meet with them and talk with them, they have concerns like you just brought up. Well, what about this in the economy or less demand? And I think that really goes back to that's another risk besides oversaturation is day-to-day operations, right? Anytime you're in something long-term, operations comes a factor, whether it's multifamily, oil and gas, or what we do. And that's why we just really want to be completely hands-off operational and participate as a merchant builder. That way we're in and out of it in a short period of time, and we don't have to worry about the long-term effects of the market. And which brings us back, I know you have one slide there. That one of the reasons I think we've got the window that we have today as a new builder is there's a lot of data out there that actually shows and supports that new construction for storage facilities is down between 40 to 50% over the last 3 years. It's even projected to be down the remainder of this year and into next year. Just as you know, interest rates were not very friendly for builders. It doesn't make a lot of sense on deals to go out and build new construction at these inflated interest rates. Now, interest rates, as you saw this morning, are starting to come down yet again, rate cut after rate cut, and that's forecasted to go into next year. So we think there's going to be a lot of people that start building next year and the year after. But the window that we've already started over the last 2 years in construction new properties, we think there's a prime window to divest of those would be about, anytime between next year and 3 years out because of this reduced spending that we've seen over the last 3 years. So it's about timing the market also. You don't want to be out building when everybody else is building. And so we've continued construction just as business as usual over the last 3 years. Now I feel like that's going to put our investors in position to divest of these within the next couple of years when you're going to see less new supply coming onto the market. There's just no other way around it.
Yeah.
Supply demand be what it will, but there's no way around, that 50% reduction in new building that we've seen.
Yeah. So that could be a really strong tailwind for
Yeah.
you.
So, yeah, it puts us in a great position. So we look to take advantage of it.
Hey, well, there you have it. I love the deal. I would absolutely consider writing a check for this fund. So,
I'll send
hey,
you our information after the call.
all right. So, to our listeners, if they're interested in learning more, they want to reach out to you, what's the best way they can get a hold of you?
Sure. You can definitely come to our website. It's just directequitysource.com, or feel free to provide my email and direct mobile number. My mobile is, you can email me at garland@directequitysource.com. Any of those avenues will definitely get you in touch. And if you're local, love to meet with you, put a face with a name. We always do property tours for people interested. I know you do some of that at the last event I met you with. So yeah, anyone local to those, San Antonio, Houston, Austin markets, love to meet you and actually go out and show you what kind of product we build, especially the small bay industrial parks. A lot of people aren't familiar with those. Those are really up and coming. Some pretty unique tenants that we've had lately. We had a pickleball club in Georgetown come in, and they took an entire facility from us. So it's not the end users that you typically would think of, with these small bay parks, but they took an entire facility, and I think they've got 6 or 8 full court, pickleball courts inside our facility. So it's pretty unique, but again, always welcome to take investors out, show them actually what they would be owning and what type of product that we build.
All right. Great. Well, thank you, Garland. And to the Beyond Stocks listener, we'll see you on the next episode.